Welcome to the channel, and if you're an Australian who depends on pension payments or you're planning for your retirement, what I'm about to share with you today is absolutely critical. We're facing a pension crisis that could affect millions of Australians, and the timeline is closer than you think. By 2026, countless individuals could see their pension payments reduced, suspended, or even completely cut off. This isn't fear-mongering. This is based on real policy changes, economic pressures, and regulatory shifts that are already in motion. Whether you're currently receiving the age pension, disability support pension, or you're planning to apply in the near future, the information in this video could save you thousands of dollars and prevent devastating financial consequences. I'm going to walk you through exactly what's happening, who's most at risk, and most importantly, what you need to do right now to protect yourself. Make sure you stay until the very end, because I'll be sharing specific action steps you can take today to safeguard your financial future. And if you haven't already, please subscribe and hit that notification bell so you don't miss any crucial updates that could impact your retirement security. Australia's pension system has been a cornerstone of our social safety net for generations, providing essential financial support to older Australians, people with disabilities, and those who've spent their lives contributing to this country. But behind the scenes, this system is under unprecedented strain, and the cracks are starting to show in ways that will directly impact millions of everyday Australians. The perfect storm of factors creating this crisis includes demographic shifts, economic pressures, legislative changes, and compliance crackdowns that are converging right now to create what experts are calling one of the most significant threats to retirement security in Australian history. Let's start by understanding the scale of what we're dealing with. Currently, more than 4 million Australians receive some form of pension payment from Centrelink. That's a massive portion of our population relying on these payments for their basic living expenses, housing costs, medical care, and day-to-day survival. The age pension alone supports approximately 2.5 million older Australians, while hundreds of thousands more rely on disability support pension, carer payment, and other crucial income support. These aren't just numbers on a spreadsheet. These are real people, many of whom have worked their entire lives, raised families, paid taxes, and contributed to building this nation. And now, many of them face the very real possibility of having their financial lifeline cut. The first major factor driving this crisis is the demographic time bomb that's been ticking for decades. Australia's population is aging rapidly, with the number of people over 65 growing at an unprecedented rate. The baby boomer generation is now firmly in retirement age, which means the ratio of working-age Australians supporting each pensioner is shrinking dramatically. In the 1970s, there were roughly 7 working people for every person over 65. Today, that ratio has dropped to less than 4 to 1, and projections show it will continue falling to potentially 3 to 1 by the early 2030s. This fundamental shift means fewer workers are contributing tax revenue to support an ever-growing number of pension recipients, creating enormous pressure on the government's ability to maintain current payment levels. Economic factors are compounding these demographic challenges in troubling ways. Inflation has been eroding the purchasing power of pension payments, even as the cost of essential goods and services continues to climb. Energy bills, grocery costs, medical expenses, and housing costs have all increased at rates that far outpace pension indexation adjustments. Meanwhile, government revenue has been impacted by economic uncertainties, shifting employment patterns, and competing budget priorities that pull funding away from social services. The fiscal reality is that sustaining pension payments at current levels, while also meeting the needs of a growing recipient population, creates a mathematical problem that policymakers are struggling to solve. This brings us to the regulatory changes and compliance crackdowns that are already beginning to affect pension recipients. Centrelink has dramatically intensified its scrutiny of pension eligibility, asset testing, income reporting, and ongoing compliance requirements. The government has invested heavily in sophisticated data matching technology that cross-references information from the Australian Taxation Office, banks, property records, employment databases, and numerous other sources to detect discrepancies in what recipients report versus what other data reveals. This technological dragnet is catching thousands of pensioners who may have inadvertently failed to report changes in their circumstances, made honest mistakes in understanding complex rules, or who haven't kept up with changing requirements. The consequences of these compliance failures are severe and often devastating. Pensioners are receiving letters informing them that they've been overpaid, sometimes by tens of thousands of dollars, due to unreported income, assets, or changes in living arrangements. These debt notices demand immediate repayment, and Centrelink has broad powers to garnish current payments, pursue legal action, and impose penalties that can wipe out retirement savings. Even more concerning, the threshold for what triggers payment suspension or cancellation has become increasingly strict. Assets that were previously exempt or partially exempt are now being fully counted. Income that recipients didn't realize needed to be reported is now being tracked automatically, and living arrangements that seemed straightforward are being reinterpreted in ways that disqualify people from payments they've been receiving for years. One of the most significant changes affecting pensioners involves the assets test thresholds and how they're applied. The family home has traditionally been exempt from assets testing, which allowed many Australians to own their home while still qualifying for pension support. However, the definition of what constitutes the family home has become more restrictive, and the value of other assets is being scrutinized more carefully than ever before. Investments, savings accounts, vehicles, caravans, boats, and even household contents are all being assessed more aggressively. For many pensioners who thought they were comfortably within the allowable limits, updated valuations and stricter interpretations are pushing them over the threshold and resulting in reduced payments or complete loss of eligibility. The deeming rates applied to financial investments have also created problems for many pensioners. These rates determine how much income Centrelink assumes you're earning from your investments, regardless of what you're actually receiving. In the current low-interest environment, many pensioners are being deemed to earn significantly more than their investments actually produce, which reduces their pension entitlement based on fictional income they're not receiving. This creates a cruel double bind where retirees see their investment income decline due to market conditions while simultaneously having their pension reduced because the government assumes they're earning more than they really are. Changes to the income test are creating additional challenges, particularly for pensioners who do casual work, have rental income, or receive periodic payments from superannuation or other sources. The Work Bonus Scheme, which allows pensioners to earn some income from employment without it affecting their pension, has complex rules that many people struggle to navigate correctly. Misunderstanding exactly how much you can earn when you need to report it and how different types of income are treated can quickly lead to overpayments and debt notices. The system has become so complicated that even financial advisors and accountants sometimes struggle to provide accurate guidance, leaving ordinary Australians vulnerable to making costly mistakes. For couples, the situation is even more complex because Centrelink assesses both partners' combined income and assets, and changes to one person's situation can affect both people's payments. Relationship status changes, whether through separation, reconciliation, or the death of a partner, trigger reassessments that can dramatically alter pension entitlements. Many pensioners don't realize how quickly they need to report these changes, or how the rules differ depending on whether you're considered a couple or single for Centrelink purposes versus other legal or tax purposes. The disability support pension faces its own unique pressures as assessment criteria have become increasingly stringent. Medical evidence requirements have expanded, and the definition of what constitutes sufficient impairment to qualify for support has narrowed in practice. Recipients are being called in for reassessments more frequently, and many are finding that conditions which previously qualified them for support are now deemed insufficient under current standards. The human cost of these changes is immeasurable, as people with genuine disabilities find themselves fighting exhausting battles to maintain the support they need to survive. Looking ahead to 2026 specifically, several factors are converging to make this a critical year. Legislative changes that have already been passed will come into full effect, including stricter reporting requirements and enhanced compliance measures. The government has announced its intention to reduce pension expenditure as a percentage of GDP, which mathematically means that as the number of eligible recipients grows, the average payment per person must decrease or eligibility must be restricted. Budget forecasts show continued pressure on social services spending, and pension payments remain one of the largest single items in the federal budget, making them a prime target for cost-cutting measures. The technological infrastructure for automated compliance checking will be fully operational by 2026, meaning that the manual review processes that sometimes caught errors before they became debt notices will be replaced by automated systems that may be less forgiving of mistakes. Data matching will occur more frequently and cover more sources, increasing the likelihood that any discrepancy between what you've reported and what appears in other databases will trigger an investigation. For millions of Australians who've been managing their pension reporting manually or who haven't fully understood all the requirements, this automation could surface problems that have existed unnoticed for years. So what can you do to protect yourself in the face of these challenges? First and foremost, you need to conduct a comprehensive review of your current situation if you're receiving pension payments or planning to apply. Gather all documentation related to your income, assets, living arrangements, and circumstances. Compare what you've been reporting to Centrelink against what actually appears in your bank statements, tax returns, property valuations, and other records. If you discover any discrepancies, it's far better to proactively report them and work out a solution than to wait for Centrelink to discover them through automated matching. Understanding the specific rules that apply to your pension type is absolutely essential. The age pension rules differ from disability support pension rules, which differ from carer payment rules. Each has its own income test, assets test, and reporting requirements. Don't assume that what applied when you first started receiving payments still applies today, because the rules change regularly and past practices may no longer be acceptable. Centrelink's website has detailed information, but the language is often technical and confusing, so consider seeking help from financial counselors or community legal services that specialize in Centrelink matters. If you're approaching pension age or considering applying for any pension payment, timing matters enormously. Understanding exactly when to apply, how to structure your assets beforehand, and what steps to take to maximize your eligibility can make the difference between receiving full payments, partial payments, or no payments at all. Many Australians inadvertently disqualify themselves or reduce their entitlements by making financial decisions in the years before applying without understanding the pension implications. For those already receiving payments, maintaining meticulous records is your best defense against future problems. Keep copies of every statement you submit to Centrelink, every letter you receive from them, and every piece of documentation supporting your reported circumstances. If you report changes by phone, note the date, time, and reference number. If you report online, save screenshots. This documentation can be invaluable if disputes arise or if you need to demonstrate that you've been compliant with reporting requirements. Consider engaging professional help before problems arise rather than waiting until you receive a debt notice or suspension letter. Financial advisors who specialize in Centrelink issues, community legal centers, and pension advocates can review your situation, identify potential problems, and help you navigate complex decisions about asset restructuring, income management, and compliance strategies. The cost of this professional advice is typically far less than the potential losses from reduced payments or debt recovery actions. Stay informed about changes to pension rules and eligibility criteria. Government policies shift regularly, and what's true today may not be true tomorrow. Following reliable sources of information, including official government channels, community advocacy groups, and yes, channels like this one can help you stay ahead of changes that might affect your situation. When changes are announced, don't wait to understand how they apply to you. Seek clarification quickly so you can adjust your circumstances or reporting before new rules take effect. If you receive any communication from Centrelink about overpayments, debt, or payment suspension, don't ignore it and don't panic. You have rights in these situations, including the right to request a review of decisions, the right to see the evidence they're using, and the right to present your own documentation and explanations. Many debt notices and payment suspensions can be challenged successfully if you respond promptly with the right information. Community legal centers and financial counseling services can provide free assistance if you can't afford a lawyer. The pension crisis facing millions of Australians isn't a distant threat. It's happening right now, and it will accelerate as we approach 2026. But knowledge is power, and taking action today can protect you from the worst consequences of these systemic changes. Whether you're currently receiving payments, planning to apply soon, or you're concerned about a family member's situation, the time to act is now, not after your payments have been suspended or you've received a debt notice demanding repayment of thousands of dollars. Thank you so much for watching today's video. I know this information might be concerning or even frightening, but remember that being informed and prepared is your strongest defense. If this video helped you understand what's happening with Australia's pension system, please give it a thumbs up and share it with anyone you know who might be affected by these changes. Your parents, your grandparents, your friends, or your neighbors could all benefit from this information. Make sure you're subscribed to the channel and have notifications turned on so you don't miss future updates about pension changes, eligibility rules, and strategies to protect your retirement income. I'm committed to bringing you accurate, timely information that helps you navigate these challenging times. Drop a comment below if you have questions or if you've already been affected by these changes, because your experiences can help others understand what they might face. Take care of yourself, take action to protect your financial future, and I'll see you in the next video with more essential information you need to know.